Hello trade pros. Since 2009, the stock market has been on a tremendous rally. But did you know that the retail investor and institutional money is not actually behind this move? So what's driving this upside, and how is the market continuing to go up on weak and declining volume? In today's video, I'm going to explain to you the phenomenon of stock buybacks, how they work and how they're supporting this upside as we experience a surge in the stock market. Let's jump right into it. What is a buyback? It is when a company decides to take cash that they've used for profit. Let's use Apple as an example. Apple sells iPhones, they make a profit, they pay the bills, they make revenue, they pay their bills, anything left over is profit. With that profit, they have a decision, they have an obligation to use it somehow because that's what the shareholders want. There's a few ways to use profit cash. One is to innovate your technology and to increase your supply chains to sell more product, which is what growth companies do. The second way is to pay it out as a dividend, to pay cash to investors. Here's some money back, which is what more mature companies do. That's what Microsoft does, because they're not going to innovate much. They already have a mature product, lots of cash. This is what you call the cash cow stocks. So Apple has been in that situation. They've had a lot of cash. They haven't really innovated much. If you guys think about Apple's products in the last couple of years, there hasn't been much innovation. Slightly better camera, faster chip, and a new outside body design. That's pretty much been the most of it. But what is another option? Companies can use the cash to buy back their own stocks. And I think this is going to be a white screen moment because we have a lot of new members here tonight, more seasoned members. You know, pardon the simplicity of this, but I think it's also a good review for you, to be perfectly honest. If a company takes cash and goes on the open market and buys their own stock, all right, that creates, first of all, a lot of demand for the stock price. It'll drive it up because this is big money. This is not you and I putting $10,000 into Apple, hoping for the moon. This is companies using cash float from sales to buy their own stock. What does that do? It reduces the amount of shares outstanding. So investors, the way they're rewarded, they now own a bigger part of the company with the same amount of stock ownership, right? Because other investors are getting bought out. It's consolidating the company ownership. So if you have 100 shares and the pie's gotten smaller, your piece has gotten bigger. Capiche? You guys get it so far? That's the dynamic of a stock buyback. However, stock buybacks, not many people will tell you this, especially people in the industry of selling products, managed products to clients. Stock buybacks are one of the biggest ways to transfer money from retail to executives at a company. And I'm going to explain to you why. Through a buyback, the real people that prosper are the executives of that company for the immediate term. That's immediate gains for them in the next 1 to 2 quarters, where investors have ownership consolidation, but for them, the uncertainty in the long term is still high. So here's how that happens. Let's say you have earnings of $1 and you have 100 shares outstanding. No matter how many zeros we use, let's call it 1 over 100. Let's go 1 over 10. You got $1 earnings for each share that you own and you have 10 shares. What's your earning per share number? Your EPS? 0.10, right? Every single owner of a share will have a 10-cent claim on that. That's how stock ownership works. Now, what if you cut these 10? If you go back and take some cash as a company and you convince 5 of these stockholders to sell you each one of their shares, and you now have only 5 shares outstanding in the company. What's happened here? What's the earning per share now on 1 over 5? 20%, right? It doubles. So your earnings per share doubles, but your actual ownership as an investor who's held into it hasn't changed as a number of shares. Yes, you own a bigger piece of the pie, but who gets compensated for that? Who does an EPS number matter for? CEOs, the executive board, anyone that gets stock ownership. First of all, they profit 2 ways. One is they could report higher earnings per share and accounting ratios. Investors pat them on the back. Secondly, their ESOP or employee stock ownership plans are worth more because now each one of their shares controls more of the company. It's kind of like a double dip. So these stock buybacks are good in limited quantities, but when you go out there and start buying your stock, it sends a message to the market. The company's saying something. Think about it if you were the business owner. I got a ton of cash, but what I'm going to do with this cash instead is buy my own shares. You're doing it to reward your executive team and you're doing it to reward investors. But what are you saying secretly? I don't know what to do with all this money. And that money has traditionally been used for innovation. And now when I show you the numbers, now that you understand buybacks, you're going to see where a lot of these gains have come from. The yellow line here is showing you by week how many weeks we are into the year. For 2018, the blue is average weekly buybacks in millions. For longer run average, the light yellow here is just 2018. All right, and as you can see, in 2018, starting the 9th week or the 2nd month, so in March, the majority of buybacks have been double, triple on a weekly basis than the long run average. And now you know who's buying stock. It's not investors, it's not retail. Institutions are selling. We know they're not buying because we have the numbers from Commitment of Traders. Year to date, they're short. I'm going to show you another chart in a moment. It's going to blow your mind. But it's the companies themselves buying back their own stock. And that's why sometimes you say, well, we just got a non-farm payrolls report. Why is the market going up? Because the money buying the stock is not a trader money. It's not speculative money. It's cash money from the company buying back their own shares. They're a buyer on the market of their own stock. And that coincides with the top of technology cycles, actually, to be honest with you guys. So let's look at the next chart. Where are these buybacks happening the most and in the first half of 2018? Look at that, technology stocks. Surprise, surprise. Let me ask you this right now. What sector right now is leading 2018 and the last 7-8 years in rallies? What sector has the predominant amount of gains in that move? The financials? No, financials are kind of sputtering because low interest rates. Tech. Okay, so tech is the leader, and this is where companies are buying back their shares the most. Interesting. All right. Financials, they're right up there as well. So financial companies, tech companies are buying back. Healthcare is the third. Consumer discretionals, and you could see some of the ETFs that are doing some buybacks are energy and real estate, but not a lot actually. They're pretty minuscule compared to what it's looking like. This is from Bank of America's institutional clients, net buys. This is in millions. 10,000 million total buybacks in the first half of 2018. That's $10 billion. Huge amounts of money coming into the market. So now you know what's kind of driving a little bit of this. And when you look at institutional clients, now let's talk about retail and institutional. Hedge funds on a 4-week average, they were the biggest sellers since May. You can see hedge funds are getting out of their positions. These are outflows. The zero line is inflows above, outflows below. Hedge funds, mostly outflows in the last little bit. Institutional clients, back to outflows. They've been at outflows for a very, very long time. Since 2016, 2015, institutional clients have been outflowing from equities. We've seen a little bit of reversal early 2018. Now they're back to outflows. Private clients, this is the private client groups of Bank of America. They've turned to net buyers, but they've been flipping around and small on average. You can see it's not really any trend. They flip long, they flip short, flip long, get out, and they're sort of on a smaller scale compared to what it was in 2011, 2012. So there's at best less amount of money going into this market. So it's not clients, it's not institutional, it's not retail, it's not hedge funds, not the private client groups of a lot of banks. It's stocks themselves buying back their own shares. All right. In a way, it's an admission that you can't innovate and you can't put that money to better use than to increase or consolidate your company and increase the investors' worth. All right. That's the picture I wanted to paint for you, because this is an unspoken truth in the market. You're not going to hear this from very many places. These reports that you're looking at cost to the tune of several $1,000s a month to receive. So those are the kind of clients that could get this info, or the kind that pay for this. All right. Last but not least, I want to show you this, and we'll move forward because this wasn't the whole purpose of this webinar. But since 2009, Private clients have outflown from equities. Institutional have been a net outflow on average. Hedge funds have been a net outflow. And year to date in 2018, this is from 2008, the present, the left chart. This one's from 2018 of January till now. Institutional outflow, hedge funds outflow. The majority is private clients, but it's only $2 billion, where the outflow of hedge funds has been 3 or 4 billion. The outflow so far of institutional has been almost $10 billion. So private clients alone are not sustaining this rally. It's buybacks.
All right, and there you have it. Today's video was a clip of our weekly market analysis live webinar that we do with our entire subscriber base at TRADEPRO Academy. It's an interactive and fun environment to learn about the week coming up in the stock market. We review the economic calendar, talk about stock market trends, and do complete technical analysis on key markets to help you get prepared for the upcoming trading week. If you want to take part in these, you can subscribe to any one of our packages and you'll be invited every single week at 8 p.m. Eastern. If you happen to miss the webinars, they're recorded and available for playback at your convenience. So hit the link below in the description and we'd love to see you at our next Market Analysis Live. That's it for today. Thanks for tuning in. I hope you enjoyed this video. Please like, comment, share, and subscribe to our channel. And when you do subscribe, be sure to hit the little bell right beside the button. And that way you'll get a notification every single time we have a new video. We do morning market updates daily between 9 to 11 a.m. Eastern. We'll see you there. Thanks so much and have yourself a great day. Goodbye.